Okay. One thing that is key of these treasury bills is that they are available weekly during scheduled auctions by the CBK so that the public can participate. Okay. The minimum amount to invest in a bill is 100,000, then upwards in multiples of 500,000. So the return of the T-bill for this week or last week was 8.19% per annum. Okay. So let me show you. No, let's discuss the bonds first, then I'll show you from the CBK website. Now, the next one is a treasury bond. Now, the difference between a treasury bill is a short-term investment between 3 months and 1 year. And then a treasury bond is a long-term investment. So basically here, the government is borrowing your money for 91 days, either 182 days or 364 days. But for bonds, these are long-term, ranging from 2 years up to 30 years. They are available every month. There are two main types of bonds. We have the normal bonds, which are known as the fixed deposit bonds, and the infrastructure bonds. So for the fixed deposit bonds, they're used to supplement the public budget. So the minimum amount is usually 50,000, and it's taxed at 15%. Similar to this, it's also taxed at 15%. But for infrastructure bonds, these are funds that go to infrastructure development, so like building roads. The minimum investment is 100,000, and it is tax-free. Okay, so if you put 100,000 and the rate is at maybe 10%, you see it will be 100,000 times 10% is 10,000. So meaning you'll be paid that 10,000. And something else to add about the bonds, they pay out after every 6 months. Let me write that down. Payout after every 6 months. Okay, I'll explain what that means. So bonds with longer terms, 10 years and above, are taxed less, typically 10% instead of 15%. Now, I've explained what these things mean. Now I want to do a practical exercise with you guys. I hope you can still see my screen. There it is. You can see my screen. Okay. Now, if you come here to the Central Bank of Kenya website at T-bills, you will see here the T-bills on offer. You can see here that the rate is 8.168%. For 182 days, which is 6 months, is 8.4. Then 364 is 9.7. Okay. So this is what happens. Let's go to the calculator. So we enter our face value. Let's say you want to invest 100,000. Okay, that is 100,000. Can you see it? Or I expand like that. With tax, yes. The rate we saw was, let's say you want to do the 91 days. It was 8.147. Post is on 91 days. Then you just come here and calculate. Sorry. So face value is 100,000. Tax rate is 8.147. 91 days, then calculate. So from the calculation, you can see that total offer amount, yeah, here it is. Now, tax amount is 298, total offer payment is 98,307. So what that means is you will give central bank, the government that is, 98,307. Then after 91 days, which is 3 months, they will give you 100,000. So the interest you have earned from that is 1,692. Okay. Now let's say you want to do for the 364 days. 364 was 9 point. Let's see. The 64 was 9.733388. $9.7388, then 100,000, then calculate. Now, what you can see, so, sorry, 364 days. Now, you see the total offer payout is 92,475, okay? And the interest amount is 7,524. Now, you give the government 92,475, then at the end of 364 days, they give you your face value, which is 100,000. Okay, basically that's how it works. Okay, are we clear? That is how T-bills work. Treasury bills work. Now for bonds, what happens now? Let me show you how to calculate bonds. For bonds, it's now different. Now we said that bonds, these are long-term investments between 2 years to 30 years. So let's say you take a 10-year bond in June. So you've given the government 100,000 in June, and the bond is trading at, for easier calculation, let's say the bond is trading at 10%. Okay. So for 10 years. Okay. So what this means is you're giving the government money for 10 years. You will not take your money. You'll only just be earning interest off that. Now, how to calculate is, so we said you'll be paid out every 6 months. So June, July, August, September, October, November, December. So in December, you expect 100,000 multiplied by 10% multiplied by, remember it's going to be taxed at, so if it's 10 years, most likely be taxed at 10%. So 90, you'll get 90% of your money. So when you do that math, 100,000, you'll be given 9,000 in December. Then in June, again, you'll be given another 9,000 all the way. So if this was June 2024, 2025, all the way to June 2020, 2035. Now in June 2035, you'll be given the 100,000 that you gave the government plus that 9,000 that you've been earning for interest. Now, if you're to calculate, you've earned 9,000 every 6 months. So in a year, you've earned 18,000 a year, 18,000 per year, multiplied by 10 years is 180,000. Then remember your capital is still preserved. So this is now interest. And then your capital is 100,000. Okay, so at the end of the 10 years, you have 280,000. Okay, so with that in mind, we can see that bonds are proper long-term. And it's very good because many people who have retired use bonds in order to earn income. We said that the amount of money that you have the amount of money that the minimum is 100,000, okay, in infrastructure bonds and 50,000 in treasury bonds. Now, let's say, for example, you remember we had talked about pension, how they can be given pension for up to like 5 million. And then if they don't know how to spend it and they are used to a lifestyle of 100,000, they'll use all that money until they reach the equilibrium of that 100,000. So if you have 9 million, let's use easier calculation. Let's use 5 million. 5 million Kenyan shillings. Okay, you've been paid lump sum for your pension, or these are your savings. Okay, so you put this in a infrastructural bond. The last infrastructural bond, the rate was at 18 point something percent. Okay, for easier, so for calculation, let's use 18%. Those are usually the rates. So at 18%, and remember it's tax free. Okay, now if you took it at June 2025, so 5 million times 18%, that's 900,000. So this 900,000 will be paid in. So June, 6 months later is December. So in December 2025, expect 900,000. Okay. Then in June 2025, expect another 900,000. Until the 10 years elapses, you get your 5 million plus all those, all the interest that you got. Now, how will I use these bonds in order to earn passive income that can facilitate my lifestyle monthly? So I can divide these bonds, they are 5 million. I divide the bonds into 6. So 5 million divided by 6. That's 833,333 per month. Sorry, divide by 6. So I take a bond in June. So here, I take a bond in June 2025. I take a bond in August 2025, September 2025, October, November, December. 1, 2, 3, 4, 5, 6. Okay. Now, the thing about infrastructure bonds, they're not as common as the other bonds, the treasury bonds, because infrastructure bonds, they're there to fund infrastructure development, and the government does not bill all the time. So you take advantage in case it is there. But for treasury bonds, they are there monthly. Okay, so let's say you take a treasury bond, you've taken in June 833,333, the same 833,333, and maybe the bond is trading at, let's say 15% multiplied by taxed at, maybe you're doing 10 years, so taxed at 10%, so multiplied by 90%. So if you have to do the math, that is 15. So 112,500. So you'll be paid in September, October, November, December, January. June you're paid in December. Oh, there's July, sorry. You guys are not telling me. There's July. So this one you'll be paid in. So in December 2025, you're going to earn 112,500. In July, so that will be in January, you're going to earn 112,500. Now this is January. August, this is February, you're going to earn 112,500. In September, if you take the bond, you'll be paid in March 112,500. In October, this is April, you're going to be paid 112,500, and you get the pattern. In November, you'll be paid 112,500. This is March, April, May, like that. Then there's no need to take in December, May, June, because in the same June, you'll be paid this 112,500. Remember, they pay out every 6 months. Okay, so the cycle repeats. Okay, so that is how you've earned passive income. And remember, you're earning all this interest and your capital is still preserved. Okay. Now, I hope you guys have understood. That is for treasury bills and treasury bonds, I know the next question you'll ask is, what if you want to withdraw your money before the time period elapses? So what happens, especially for treasury bills, you see there are short-term investments. When you withdraw your money before maturity, what is going to happen is you're going to sell it, you're going to incur a loss in that. Okay, so the government does not want you to withdraw your money before maturity. This is not a bank where the government is storing your money. No, 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 no. They are using your money for investment. Okay, so you're going to incur a loss. So this is to discourage early withdrawal. Okay, picture it as a locked account. Okay, so any questions on T-bills and T-bonds? Now, the next thing is, how do you open in case you want? So there are two ways. Number one, there is the CBK app. They have an app. It's called CDS. Let me check the name. CDS. You just go download the app, CSD, in App Store or in Play Store. Okay, register all those things. They'll ask for your KRA PIN, a passport photo, and your ID copy. Then you just register. Then you bid. Okay, you just bid. You see, when a bill is coming weekly, because they come in weekly, you just bid it. You get your bid is accepted, and you wait for your money to grow. For the bond, every month, you bid, accepted, wait for your money to grow. But if you don't want to do that and you feel that is a lot of work for you, you can just go through banks. Okay, so these are your normal banks, the KCB, Standard Chartered, and all those, or investment banks. Okay, they will help you with that process. They do everything for you. Okay, but they'll ask for a commission. So maybe I think 2% or 1% of your potential earnings they'll be taking from that. Okay, but this one you have to confirm with the bank or investment bank you sign up with. Okay, so there's something before we go to the next product known as the secondary market. So for the secondary market, ideally what happens, you see, not everyone who puts their bonds for those 10 years, some would want to withdraw. Okay, so if you need to withdraw, you will sell your bond to the secondary market. Okay, so this is mostly through the banks and the investment banks. You go invest there. So what happens is, you say, you tell the CBK, oh, you want to withdraw your money, maybe you have something to do with it. You sell it to the secondary market. Someone will buy that bond, then you get your money back. Okay, so this is through the banks because they are brokers. Okay, so I want you to unlearn the term brokers where it means something bad. In investing, a broker is someone who connects you with an investment product. Okay, so it's a very good thing, not the bad broker that you're used to. People add brokerage fee, but they are still the same. They will add their brokerage fee. Okay, so I hope you've understood that. Any questions on T-bills and T-bonds? No questions? Okay, good. We go to the next product. So for the next product, it's not really an investment per se. I'll explain what it is. Money market funds. Who has heard of money market funds?
Maybe before you go to money market fund.
Yes, on T-bills.
Yes, just to share some information on the banks or investments.
Yes, yes.
Most of the banks, when you go to them and you want to actually buy, they will tell you that they themselves have the interest. So first they want you to actually give them the money rather than giving out. So that is something that maybe this family needs to know, that many times the bank actually twist you into giving them as a fixed deposit rather than taking it to the other banks. I mean, to the treasury bills. Yeah. Yeah. So that's just for information.
Yeah. So thank you for that. I even didn't know because I usually go direct via the CBK. I've never gone through the banks. But yeah, so at least you've known. Okay.
I don't know if you can hear me now.
Yes, we can hear you.
So just going back to this app where you are doing it by yourself, let's say for even something as big as an infrastructure bond where you have a huge amount of money, are you still interacting through the app, or is there another way other than going through a bank? I'm just thinking because for large sums of money, you might want to feel comfortable knowing that you're transacting with somebody outside of than an app. Your comments.
Oh, yeah. So you see, what used to happen was I remember even when I signed up for the T-bills, that was back in 2022, this app was not there. The DOSI CSD app was not there. So what used to happen, you go to CBK with your ID, KRA, passport photo, you stand in line, they verify your documents, take fingerprints, all those things, and approve your documents in like a week. Then bidding, the same thing. You are to bid, go to CBK, but they made things easy. So you just go to the app and bid from there. Now you have to link your bank account. So for example, if you have that 5 million in your bank account and you want to bid for an infrastructure bond, it will be there. You'll just see workings of the app. Maybe I look for a good YouTube video that shows how the app works. It's very easy to use. You just go bid there. Once accepted, the money will be deposited at CBK. Then you'll just be earning your interest after those 6 months. They pay immediately, just comes to their bank account. And like that. Then after the 10 years or 5 years, the amount of time you've taken, your money will go back to your bank account. That's how it is. So no need to interact with CBK staff, no need to go to town. They simplified it. But if you definitely remember, this is your money and you don't want any issues, you can just maybe go to CBK, they explain it to you because they have very good stuff. They show you how the app works. They tell you, okay, yes, this is how you bid, like that, like that, like that.
Okay.
Yes.
Okay.
Okay. I think that's okay. Now we go to the next one. So how many people have heard of this?
I've heard of it.
You've heard of it, okay. Anyone else?
Yeah, but not much.
Not much,
We
yeah.
don't know what it is.
Okay, yes, I'll explain what it is. So I got to find out that money market funds have been there since time immemorial, but they got a boom maybe in 2021, around 2021 is where now many people started engaging in them, but they've been there since time immemorial. Okay, so what are they? So money market funds are funds managed by a fund manager, okay? And he invests your money in certain ways. The fund manager invests your money in certain ways, okay? I'll show you what they usually invest in, okay? Because you remember when we were talking about risk, you have to know where does your money go as you give someone, okay? So there are some things that money markets do. I won't really call this money market fund an investment, but it is because we said an investment gives you capital appreciation, isn't it? So any form of capital appreciation gives you an investment, but I'd refer money market fund as a savings platform. Okay. Why I say that is because your emergency fund, you remember we had talked about an emergency fund where you accumulate money every month and at least make sure you have at least 3 to 6 months of your daily cash flow, which cash flow is just your income minus your expenses. Okay. That amount of money, at least 3 to 6 months. And then if you're a sole breadwinner or a business person, at least 9 to 12 months of your income. Okay. So this is where you put your money in money market funds. Okay. Now, the features of money market funds, they earn daily compounded interest and they're easy to start. Now, here are the key features. Number one, they are low risk. These funds invest in highly stable and low risk securities. So we are going to see what are those highly stable and low risk securities. Okay. Short-term investments, the securities they invest in are usually mature in less than a year. Remember we said short-term is less than a year. Highly liquid or high liquidity. You can usually access your money quickly, making it almost as accessible as savings account. For example, the money market fund, the money market account I use personally, withdrawing is at an instant. You just fill in, you don't even do anything after you've been saving in that money market fund and you want to withdraw. You just go, click, maybe you want to withdraw 1,000, instant to your M-Pesa. Okay. And then modest returns. Returns are generally higher than regular savings account, definitely higher than savings account, but lower than stocks or bonds. Okay. Savings account, you see, when you put your money in a bank, there is a savings account and there's a current account. Now, the current account is the scam one. Why I say scam is because your money is actually losing value because it's like putting your money under the bed. Remember we talked about inflation? Inflation is not going anywhere. So you're losing money at the end of the day. As much as the value of the money is 100,000, but the goods and services that you can purchase for that 100,000 is not, your purchasing power is lower. Okay, that is a current account. For a savings account, these banks give you poor rates. I've seen banks 3 to 4%, 5%, like they barely beat inflation. So if inflation is 9% and your bank is giving you at a savings account of 4%, you see you're still losing 5%. Okay. Now, we now go to where do these money market funds invest your money? Number one, they mainly invest in government securities. If you can see this chart, this is an asset allocation of where your funds go. Okay. So number one is asset securities, which is 41% of your assets. So if you give them 100,000, 41% of it is going to government securities. And then we have, so government securities is what we have talked about, treasury bills. So they are not allowed to invest in treasury bonds, okay, because this is a short-term product, okay? So they invest in T-bills, only T-bills, not T-bonds, okay? Then we have something known as commercial paper. Commercial paper is a short-term unsecured debt instrument issued by companies to raise capital, okay? So some companies may want to raise capital, they issue something called commercial paper, okay? So a company, let me give you an example. A company like Safaricom may issue a commercial paper at like 12% interest for 6 months. So this money market fund manager will go invest in that, keeping your money accessible. Then we go to fixed deposit. So fixed deposit, what does that mean? So these are bank deposits for a fixed period of time. Usually 30 days, that is 1 month, 90 days, 180 days, or 1 year, not more than 1 year, okay? So a bank like Coop Bank can do a fixed deposit, 90-day fixed deposit at 11%. Then the fund managers go and invest in that. And then the last one, cash and call deposit. Cash and call deposit. These are highly liquid deposits held in commercial banks. Okay, and they can be accessed on demand. Okay, now, so the thing about money market funds that you have to know is choosing the right money market fund. So number one, you have to look at the rates they give. Okay, there are different rates. Different money markets give you different rates. Some will give you as high as maybe 13%, some as low as 3%. Okay, number two, you look at sustainability of the company. So these days, banks, I think all banks have money market funds. Okay, there's even a money market fund for Safaricom. If you guys didn't know, it's known as ZD. Okay, these days that is the product in the market. So you look at that, and then number three, you look at the structure of the money market fund in terms of their shareholders, their directors, a brief history of that, because those are important things you should look at. Okay, to know the best money market fund to invest. So for this is called Etika. This is the money market fund that I use. I was using Britam at first, but due to one reason or another, I changed and came to Etika. And I've had no issues with Etika. Why I love Etika is number one, their app is very easy to use. Depositing money is very easy to use. Withdrawing money is easy, like that. Has no challenges. Okay. Then they usually send you these key fact sheets that is good. You know, remember I'd mentioned that it's very important to invest in financial literacy. At least know how to read a financial document, a balance sheet, you know, financial fact sheets like this. Very, very important. It goes a long way so that you don't just invest blindly. So they'll tell you fund inception date, February 2023. The average rate return for May 2025 is 12.9% per annum. There's no lock-in period. Management fees is 2% per annum. Okay. The benchmark is usually the 91-day T-bill plus 1%. Minimum investment is 100 shillings. It compounds daily. Their trustee is Bank. Custodian is Equity. Fund manager is now Etika itself. Regulator is CMA. Then the auditor is RSM, Eastern Africa. So they usually invite people for their annual general meetings where they declare their income. They are required by law. Remember, it's regulated by the Capital Markets Authority. They are required by law to release their financial results yearly, properly audited, so that the shareholders can see what they're investing in. Okay? Clear. So for a money market, remember this is where you should be saving your money. Ideally, the amount of money that you should have in your current account, which is your bank account, is the amount of money you plan to use that month, maybe 1 or 2 months in your current account, while the other amount of money is now up to you. You think of how you'll invest that money. Okay, because remember, if you have money in your account, it's not earning any interest. You're not beating inflation. Okay, so have different money market funds. You might have a money, remember, we go back to financial goals. You might have a money market fund for school fees, where you save and keep your school fees there as it earns interest. Number two, we have, you want to travel to Dubai during Christmas. Start saving early as now. Put it in a different money market account. Emergency savings, instead of putting it in a bank, put it aside into a money market fund. Okay. So you can create different money market funds within the same fund manager. For example, in Etika, you can have money market A, where you label school fees, B like that, C like that, your different financial goals. Okay. Now, what do you need to open an account? Simple. We know it, we call it KYC. It's called Know Your Client. So you need an ID. So this is a copy of an ID. You need a passport photo. And then you need, the last one is KRA PIN. Okay, that is usually what you need. And then the next thing is you deposit. And you watch your income grow. Okay. Now, there's something here I mentioned, daily compounded interest. Now, I want to show you guys what that means. Now, I've given you an example here. You have 1 million at 10% for 100 years. Now, why I'm saying this is because, let's say, for example, your great grandfather, yes, left you 1 million Kenyan shillings for it to be used by the grandchildren. And he put it in a money market fund that has an average yield of 10%. But then the average yield of money market funds is 10% because last year, around June 2024, July 2024, it was as high as 18%. But right now it is, as you have seen, it is around 12%. So let's just be conservative and use 10%. And we have 1 million. And the guy leaves it for 100 years. Before I show you how it's calculated, who has a guess of how much this amount of money will be after 100 years, compounding at 10% daily? I want everyone to try to say, then I'll see who is the closest. You can type on the chat to show you the magic of compound interest. Someone will say 10 million. Another one? It's not a must to calculate, just get a guess. After 100 years, 10 million. Wow, you're quite conservative. Anyone else? Type on the chat or you can unmute. I want everyone to participate. Someone else has said 100 million. And the rest? Now, let me show you. Let us calculate. Now, an initial amount of 0. No, so yeah, the 1 million. He had 1 million in 2032. Sorry, we're in 2025. So 1925, he gave you 1 million. He did not top up. And we are using a conservative rate of 10%. And it is being invested daily. It's being invested daily for 100 years. Okay. Now I want to show you. Now, before I show you the amount that it's going to give, I want to give you a very practical example that happens in our life. Now, what is going to happen is, before we even do this, the math, this great-grandchild, the great-grandfather, has two options. He'll either do this, or number two, he'll buy an 100 acres piece of land. Okay. Assuming at that time, 100 piece of land was at 1 million Kenyan shillings. Now, this 100 acres, you're supposed to divide it between you, the children, grandchildren, and great-grandchildren. So those are 3 generations. If we are being conservative, let's say the first guy had 3 children, okay? 3 children. Then of those 3 children, they had, let's say, even 2 children. 2 children each. And then of those 2 children, each child had 2 children. So this is the children, grandchildren, great-grandchildren. Okay, so these are 2, 2, 2, 2, 2, 2, then 2, 2, 2, 2. Okay, so let's see how much it will be divided. So we have how many people are participating? 1, 2, 3, 4, 5, 6, 7, 8, 9. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21. Those are 21 people that are participating in this family tree. If he left 100 acres of land, That is 100 acres divided by 21. Every person gets 4 acres of land. And you see, 100 acres of land is quite a big place. Divided by 21, assuming everyone gets equal, they'll have 4.7 acres of land per person. Okay. This one makes sense because you see, this will be 100. So before he dies, this one gets 33, 33, 33. Then this one divides that 33 into 16.5, 16.5. And then the last one gets 4.7, like that, like that. Everyone gets half of that. Okay. Now, so we have seen everyone gets at least 4.7 acres. But let's assume he did not buy a piece of land. He put all this in a money market fund. Let's calculate. How much money is that? Can someone read for me this? How much is that?
That's a lot of money.
Just read it.
1 billion.
31 billion, 996 million, 318,000,
30.
Point
519 shillings.
519. Now, which one would you take? And we have how many descendants? We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 21. So 21 billion divided by 19 descendants. Everyone gets
A B plus.
a B plus. Now, have you seen the power of compounding?
Yes.
Have you seen the power of compounding? Compounding is the best thing that has been introduced in finance. Nothing beats that. And that one shows you time is the biggest factor. Because if we slash this into half, let's do 50 years. Let's do 50 years. Calculate. It becomes 148,311,559. Have you seen how time is a big factor?
Exactly.
So you have slashed it by half, but look at the difference. You had 21B and now you have 148 million.
Very huge.
So time is your biggest factor. Now, with that knowledge, what do we do? So remember we said consistency, discipline, and what?
Patience.
Patience. Very good. Now, let's use, there are 2 generations here. We can use, I want to show you one other thing, the last thing. Let's use 2 generations. We have John, who is young, has just been employed, has started his job at 26 years old, and he wants to save for 20 years till he's 56. And he wants to top up monthly 2,000 shillings. Let's be generous, but 2,000 is too little. Let's say 5,000. He's saving every month. Initial top up, 0. He had nothing. Interest rate, let's just use 10 for 20 years. For 20 years. So how much is that? 3,000. No, not 3,000. 3 million?
3 million.
See, it's 3 million. From a contribution of 1.2 million. Yes, 5,000 shillings every month for the next 20 years.
It's 3.8.
3.8 million. Isn't it?
Yes.
Now, let's use another person. So you see this guy, he has done 20 years. Sindio? At 56, he has stopped saving. But now, how much does he have? He has 3.8 million. Now, for this 3.8 million, let's say he does nothing to that money. So 3.8 million, let's just use 3.8 million. He doesn't use it at all. He just puts it at the account. That's 3.8 million. Okay. No top up. He's done saving. And he wants to spend the money when he's 65 years old. Okay, remember he's 56. So 65 minus 56. that's 9 years. How much will he's topping up nothing because he has finished saving. He's looking into other things. How much will he have?
1.3.
9.3 million. Okay. Now let's take someone else who started when she was 40. She's saving the same amount of money. She started late, 5,000. She also had nothing at an interest rate of 10%. And she wants to do at 65. 65 minus 40, still 25
Right.
years. No, let's use 20 years so that they're the same. So 65 minus 20. No, sorry, 40 minus plus 20, 60. She stops investing at 60. Are you seeing they're all the same? They're all the same in terms of they have invested for 20 years. But John started earlier and he didn't withdraw his money. So this person will have 3 million, 3.2 million, 3.8 million by the 60th year. But John had how much by the 60th year? 9 million.
3.8. So
How much?
3.8.
No, by the 60th year. At that time, John was 20 years old.
Oh, yeah. Okay.
How much did John have in the 60th year? Was it 9 million? So we have done the math.
9 million, yes.
9
Yeah,
million.
it was 9.
It was 9, isn't it? So what I was trying to show you from those two people is, you see, John started earlier, saved for 20 years, stopped saving, but did not withdraw his money, and had 9 million at the end of his savings. But he saved for 20 years. The other one, Mary, she started late, saved for those 20 years, but by the 60th year, she had less money than John. So are you seeing the power of compounding?
Mm.
Okay. And let your money work. Because imagine if John had withdrawn the 3.8 million. You see, he left it and did his own things. Okay. That is the power of compounding. And that is what we have. So the earlier you are, if you're 16, 17, 18 years old and you build that habit, by the time you're 40, 50, you'll be way ahead of many people. Okay. Any questions on money market funds?
I have a question.
Yes.
Back to, I think you called the fund you use Erica. Is it Eric?
Oh, Etika. Yes.
Etika. There you mentioned that I don't know if I got it right, but you can explain it's whether they have a limit of 1 year of saving, or is it something that it is as long as you want?
Where had I mentioned 1 year?
I don't know. Maybe I didn't hear.
Oh, no. You can invest as long as you want. Like, as long as if you just open an account, you can invest as long as you want. Maybe what you're asking is the lock-in period.
No lock-in period. Now, I read that no lock-in period.
Oh.
Okay. I think then I understand,
You understand?
that it is unlimited. So these money market funds, you determine how long you want.
Yes.
Keep saving.
Yes.
You have an option of removing it anytime, but if we use the example of John, John knows he can remove the money anytime, but
yes,
he continues to just let it grow. Right?
Yes.
Okay, and then the second question
Does it have
I have is,
yes.
yeah, ma'am.
Continue, I'll ask later.
Okay.
The next one is like, there's a very famous money market fund for Standard Investment Bank called Mansa X. I want to just hear your opinion about that money market fund because it's very popular. And finally, are there money market funds that are high risk?
Okay. Let me start with the Mansa X product. So Mansa X, I think what you're talking about is their mutual fund product, the one that gives around 20% yield. Just to confirm, that's what you're talking about.
Yes.
Or just
yes,
their money
yes.
market one.
I think I'll check one. There's one that everyone is raving about.
Yes.
Just
The
continue.
one everyone
Yeah.
is talking about is it's called a mutual fund yield account. So that one, it's different from a money market account. So for Mansa X, it's used by Standard Investment Bank, isn't it?
Yes.
Now for that one, it's a different type of fund. Okay, it's still a financial asset, but they invest in other things. So for Mansa X, first of all, number one, the minimum amount of money you can invest is 250,000. They offer very high yields. I think last year's yield was 20 point something percent, 20 point something percent. Okay. That special fund, the Mansa X special fund. And then the question is, where do they invest your money? So they don't invest our money in such products, the government securities and all those things. Those form part of what they invest in. But the reason why their yields are so high is because they invest in securities exchange. So their main target is Nairobi Securities Exchange, what we're going to talk next about, this one. And then the other one is the New York Stock Exchange. I don't know if you guys have heard of it. So they buy the shares, these common products that we know, Apple, Tesla, Alphabet, Google and all those things, Facebook, all those things. They buy those shares, wait for a year, then sell it at that high price. That's why their prices are very high. So the risk is higher compared to a money market fund. Okay.
Yeah.
Yes. So that's where you remember we said you have to know the risk. Return of investment, you've known it is 20%. The risk, slightly moderate to high risk. And then we go to, are you willing to take that up as a person? Yes. Okay. Yes, that special fund. Okay. And then the last question was, are some money market funds high risk?
High risk, yeah.
Ideally, they are not allowed to invest in other products other than this. Remember, the Capital Markets Authority regulates this product. So they are told you should invest in short-term products and you give a financial audit. So a money market generally is not a high-risk investment. It's a low-risk investment. Okay. Yeah.
But this one for Mansa X is not a money market fund.
No, it's not a money market fund. It's a special fund.
A special fund.
Yes.
Okay.
Yes.
Keep planning. Thank you.
Yes. Okay. Yeah. We go to, so here we are clear. We now go to, so this should be C. NSE. Who has heard of this? Nairobi Securities Exchange.
Index.
Anyone?
NSC.
You've heard it?
Yeah.
Apart from you, anyone else?
Yeah, we've heard.
Yeah, I have.
Okay. That's good. Now, so NSE, if you've heard of it, that we are investing in stocks. One thing about investing in stocks that I usually tell my friends and how I usually sell this product to them is, if you are using a product and you use it every day, for example, you're using your phone, use Safaricom or whatever service you use, Airtel or anything, you're using any product that you use daily, and you know that you cannot live without it, and you know that you cannot live without it, and it will continue to exist because every person is using it daily. Ask yourself, what kind of company owns this product? And how can I be a shareholder? How can I gain money from what I'm using already daily? Okay. In fact, that is how I got to learn about the NSE. My friend told me about it. Then I did my research and I got to see, I'm using this product, which is in my case, which is Safaricom. I'm just talking about it. I'm using it daily. I buy airtime daily. I transact with M-Pesa daily. I'm making money for the company. But me, as a customer, how am I benefiting? Okay. I'm not benefiting in any way. So I said, no, it cannot be. So why not own a piece of the company? So that as I even use it, I feel better. I'm like, okay, regardless, I'm still going to transact. They're going to, there are going to be transactional costs. I'm going to buy airtime. I'm going to buy bundles and all those things. So from that, I said, yeah, I should at least own a part of it, be a shareholder. Okay. So it's made possible by something known as the Nairobi Securities Exchange. Now, here's where we do something known as stock market investing. Okay. Stocks go, so there are two ways of making money in the Nairobi Securities Exchange. We have through capital appreciation, we discussed this, the capital income, where the increase in value of the stock over time, and the dividends, payments made by a company to its shareholders, usually in form of profits. You can have two types of dividends. We have paid in terms of cash, where they give you cash dividends or additional shares. They tell you maybe as a shareholder, we're giving you a discount to buy this stock at this price. Okay. Now, for investing in the NSE, so I'm seeing time is going and I want to do really fast, but I don't want to rush. So let me just be brief so that you can understand. There are two main ways to invest in the Nairobi Stock Exchange market, NSE, investing in stocks. Number one, growth investing. And number two, dividend investing. Growth investing is what we call trading. Okay. The aspect of the stock exchange market is very simple. Buy low, sell high. That's how it is. Sounds simple? It is that simple. But in the ground, it's not that simple. But that's the principle. Buy low, sell high. For example, buy Safaricom at 5 shillings, sell it at 30 shillings. Buy it at 10 shillings, sell it at 50 shillings. That's the principle. It's known as growth investing, where you're trading. Okay. Number two, dividend investing. So maybe something to mention on growth investing. This is a very short-term type of investing. You buy a stock when it is low, the price is low. Then anytime the price goes up, you quickly sell it and make a profit. But this one is mostly by traders. There are people who they do trading for a living. They are trained in market analysis, looking at charts and the data. Those are the main things. The difference between this and gambling is that in trading with stocks, it is data driven. You can predict if a company is going to do well. Maybe they got a foreign investor, they expanded to a new market and all those things. It is data driven. So you know what you're doing. But in gambling, you don't know. You're betting on Manchester United to win against Arsenal. No, that is emotional. That is gambling. Okay. Now, the next one is dividend investing. Now, this is what my main teaching for today. It is a long-term investment. Okay. A very sustainable and long-term strategy. So what happens here? You buy shares from a company, okay, that you know. So this is what I'm explaining, how to start investing in the stock market. You choose a company or companies, okay? Pick a company where the business model, you understand the business model, okay? Best performing companies in the industry. In the NSE, there are two types. There's number one, telecommunication, which is Safaricom. It is the best performing company for years and years. And the next one is banks. Banks will forever be performing as long as people are taking loans, people are depositing their money in banks. It will forever be among the top performing companies. So banks, all the banks you can think of, ABSA, Equity, Standard Chartered, DTB, Family Bank, all those banks are in the stock exchange market. Okay. Number one. So you've chose the company. And here we don't just guess. Okay. You have to know. Okay. You do evaluation. So that's why you invest in financial knowledge, financial literacy. Okay. Go through the financial statements. So for example, you want to invest in Safaricom, you have to know what are the financial statements, profit and loss statements, balance sheets. Learn to read on these, okay? See if this company is in a healthy state, okay? And then some things, good indicators of a succeeding company, the future plans of the company, okay? See if it's sustainable in the long term. Now, you have identified the company, okay? One thing I want to mention about this stock market trading, it is not for lazy people. So if you're generally lazy, it's not for you, okay? You must do your homework and research on these things. Keep up with the news, keep up with trends, okay? Number two, choose a stockbroker. There are multiple stockbrokers out here. You can go to the NSE website and see there are multiple stockbrokers. My personal stockbroker, I can give them a shout out. It is known as AIBX. He's a very good stockbroker. I recently moved from my previous stockbroker because tulikuwa tunasumbuana. Yeah. Okay. You see, I'm a person who does my homework, so I expect the stockbroker that I have. You see, when you join a stockbroker, you're given a financial advisor. So my financial advisor tulisumbuana, nikabadilishiwa. They were all just disturbing me. Then I changed. I went to this very wonderful stockbroker. The reason I like them is because they have an online trading platform, an app, very easy to use. You can buy stocks there, okay? They have moderate fees. They charge 1.5% per trade. That means is if you're buying Safaricom shares of 20, Safaricom shares trade at 20, and you're buying 100 of them, you'll be charged 1.5% multiplied by 2,000 because you're spending 2,000. Now that's 30 shillings. They'll charge you 30 shillings for that. So you'll pay 20.30, okay, in order to buy this stock, which is very moderate because stockbrokers mainly charge 1.5% to 2.5%. My previous stockbroker used to charge me 2%. I got to learn that. I thought that was a good deal. See, I didn't do my due diligence. And then good stockbrokers like this, they offer advisory services. So in fact, why I like ABXs is because every day, every week, and every month, they offer the advisory services. So you'll see the trends on how stocks are doing. For example, this is how it looks like. This is the company. It's called Daily Whisperers. On 20th June, equity year trade less than 4, it was 4.6%, but the upside was 2.3%. So they offer you advice. They tell you the investment rationale, all these things, then they tell you to buy. Then things like Standard Group, they tell you to sell because of such reasons. So you keep up with the news, KPLC, Coop Bank, BAT. This is British American Tobacco, okay? Progressive dividend policy, you have to buy, okay? With this, you build confidence as an investor. So these days, I'm very knowledgeable in terms of, such things, okay? Then the next one is open a brokerage account. So in a brokerage account, this is known as CDSC, Central Depository and Settlement Account. If you go to your broker, they're going to help you open it. Then from there on, you start trading. Definitely, they'll need your KYC, which is, you remember we said KRA PIN, ID, and passport photo. Okay. One thing to mention about the NSE, the stock market opens from Monday to Friday. Let me write Monday to Friday from 9 a.m. to 3 p.m. Okay. Closes on the weekends and public holidays. The minimum amount of shares you can buy for any company is 100 shares. Okay. So, for example, you want to buy Safaricom, it's trading at 20 shillings per share. So you'll have to spend at least 2,000 shillings. You see, it's not even a lot of money because most of these companies, their share price is below 100 shillings. Okay. One notable account is like StanChart, which is 269. So for that, you need to spend 20,000 for the first 100 shares. KPLC is like 7, 8 shillings and things like that, generally. Okay. Then you can only buy in blocks of 100. So for example, you buy 100 shares, 200 shares, 300 shares, 400 shares, 500 shares. Okay. Then after buying, you have to stay updated. Okay. Keep tabs on your stocks. Know that you're owning 100 shares of Safaricom, whatever shares of a company. Okay. Companies usually publish their financial results at least 6 months. They're required by law to publish at least 6 months, every 6 months. So December, July, December, July, December, June, December, June. That's most of the companies. Okay. So stock market success is about information and patience. You have to be very patient. Remember, wealth is grown over time. And then information. Then the dividends, these companies pay out dividends. And you can choose how you'll receive your dividends. If you want to receive your dividends via M-Pesa or bank account, they send. Sometimes I'm usually very happy. Sometimes I don't keep trend with the market, but I'm just, you're just chilling, doing your studies. Then you see your M-Pesa, shoo, you've received maybe 2,000 shillings. They tell you, oh, congratulations, you've received dividends from KPLC, yeah. So that's a form of passive income. Okay. Then how to keep active with the NSE and financial knowledge on the stock market exchange. Subscribe to things like Business Daily. I'm sure you guys have seen Business Daily, things like Kenya Wall Street. They give you the economic business updates, stock insights, and what the company is about. Okay. Now, the don'ts for this, for the NSEs, are number one, do not observe daily price changes. You see, like for this one, it changed by 4.6%, this one 7.1%, moved by 77%, moved by 10%. These are just very, very temporary. Okay. Stocks go up and down every day. Okay. And when a stock price falls a little, just like a price, don't panic. It's normal. Okay. But when you see it falling, remember, you're keeping up to date. You're being advised by a stockbroker like this one, you've been told to sell, just sell. Okay. So at the end of the day, we have learned that stock market will grow your wealth over a long time. Patience, consistency, and you have to be willing to learn. Do not be lazy with your money. Okay. Now, the second last one, unless you have a question there. This is known as REIT.
That's a really, really quick question on the stocks, yeah?
Yes,
How
yes,
easy is
yes.
it to sell the stock? Like, if just like practically, you could explain to us, let's say you have KPLC shares you want to liquidate and use that money for something else. Maybe you could describe for us how long that process takes and what is required of it.
Okay, sawa. So maybe I'll start with buying. So buying, you just go to the website and you'll see their KPLC is being traded. So you put in a competitive bid. There's usually a price range. So for example, let's use KPLC. Okay. Sorry, I've taken so much time. So let's say KPLC, the price is 7 shillings at 9 a.m. as it started. This is the previous day close. It's closed at 7 shillings, okay? You want to buy it, okay? You can bid for 6.5 shillings. For you to bid and want to sell this, there's someone who, and want to buy this, there's someone willing to sell their share at this price. So maybe you want to buy 100, so that will be around 650 shillings. There are going to be miscellaneous fees for brokerage fee and that, but let's just use 650. It's as easy as just bidding for that, waiting for people to trade. And you see, from 9 a.m. to 3 p.m., there'll be multiple trading cycles, around 20, 30, 40, depending on the company you want to buy and sell. So at that, it will be credited to your account. Within 3 days, you'll be credited that you have KPLC. That is 100 shares. 100 shares you bought at 6.50. Okay, so when the share price goes up, it will show a green arrow that maybe the share price is 7. Now, let's say you want to sell. The share price at the beginning of the day is 7. You want to make a profit. Maybe you bought at that 6.50. After maybe 6-7 months, you want to sell. At that time, maybe the share price is, let's say, 7.50. And you put in a competitive bid, maybe 7.60 multiplied by the 100 shares you bought. That's 7,760. Someone is going to buy the ones that you're selling. Then you'll be credited on your account. It takes between 1 to 3 days for you to get your money. So depending, it goes to your account for your brokerage. Then withdrawing is just simple. Immediately, you just withdraw to your M-Pesa. Okay. You see how highly liquid it is?
Yes, I do. And just quickly to ask, are there scenarios where no one wants to buy? Maybe you're all selling.
It depends. Now, quite rare. Like, for example, company X, everyone wants to sell it.
Maybe
it
there's a
rarely
scandal
happens.
and people have lost trust in the company or something like that.
Now, you see what happens there? They are smart people. What is going to happen? There'll be an influx of selling. People want to sell it. So what will happen to the share price? It will dip. Okay.
Yes.
So it was maybe 7.5. Maybe there was a scandal or something like that. It will dip to maybe 6.5 or maybe 6. Now, remember, these investors want to make money. So a scandal is a very temporary thing. So if you put at 7.5, nobody will buy it at 7.5. But if you put a competitive bid of 6.5, you will still, people will buy at this 6.5. Then after the scandal is over, 3 or 4 months later, the price range goes up. It can even go up to 9. Now, the people who bought it at 6.5, at that time when you are selling it at a loss, can now sell it at 9. Okay?
Yeah.
That's how it works.
Okay. Thank you.
Yes. But it's very good to be informed and all those things. That's why we buy the top companies. Okay? You've done your due diligence, your research on the market, and you've got the top companies. And this one, anyone can start. As long as you have, we said, KRA PIN, ID, passport photo. So even if you're 18 years old, you can start. 60, you can start. Okay, so long as it aligns with your financial goals. Okay. Now, this is the second last one. Then circles, then we are done.
Maybe before the second last one.
Yes.
So are we still, when you're talking about the NSC, the place where you talked about the CSD.
Or CSDS, yes. This one. CDSC, this one.
Yes.
The account, yes.
Yes. Yeah. Just to encourage them that one time I was actually buying, I think from Sandy Big Bank. And there was also, so that's the time Safaricom was also selling. And I realized actually that I was working, but there was a chokora who was also buying Safaricom. And he even had more than me. I sold it later on. I think I wanted to encourage Winnie, Dr. Winnie, that when I wanted to sell, it didn't take so long, but I managed to sell it. So, and I wanted to bring the issue also of it did not matter. Anyone can actually be able to buy. That was a correct. We're buying. I was working, and he had collected from wherever. I looked at his notes, they were folded and folded and folded, but he bought a 50,000 shares.
Wow.
I mean, shares worth 50,000. And I was buying at 30,000. So you can imagine, actually be able to make it. Thank you.
Yes. So yeah, you've seen how people can make money. We said through dividends and capital appreciation. Okay, so it's possible. There's also this guy I was hearing. He was in a podcast. He was saying how he traded his money. So there's this company that was selling cables that came during the Mwai Kibaki era when he was president. And Mwai Kibaki had said, oh, things to do electricity, and they won that tender. So at the beginning of Mwai Kibaki's tenure, the price of that company was, I think, 5 shillings. Okay. But when they won that tender, you see, when you win a government tender, what happens is you get exposed, people know you, the company is flourishing and all those things. So the price shot up over a period of 9 months. It went from 5 shillings all the way to 30 shillings. So he and his friends had spoken. They each had contributed an amount of money. It reached around 1 million each, like 300,000, 300,000, 300,000. So they went, the price reached 30 shillings, and he was very shocked because you see, they invested at 5 shillings, both shares worth 1 million. Then it reached 30. So a million divided by 5, they bought 200,000 shares. Times 30, you see, it's 6 million. When they saw it's 6 million, they decided, we have made so much money. They sold at that time when it was 30. The company continued, did well. The share price went up till 60. Then it started going down after the tender was over and market fluctuations. I don't know what now the company trades at, but yes, that was the story. So they made 6 million divided by, so everyone made from 300,000 to 2 million each, 2 million, 2 million, 2 million. And that's how he was introduced to stock market trading. Okay. Yes. Okay. But for us, we have said, as much as yes, there's that growth investment, we're also investing for the long term in terms of dividend investment. Okay. Now, rates. Who has heard of rates? Real estate investment trusts. Who has heard of that? Anyone? Anyone? Never heard. Oh, yeah. So this is why, this is one of the reasons the West are better than us in terms of real estate. So these days, real estate has taken a new pathway of investment. If you guys engage in financial talks, read financial books, or just follow financial knowledge, you'll hear that many people in the US and these Western countries are rich through real estate. Now, I was asking my friend the other day, so you've heard of that, isn't it? Many people are rich through real estate. But what does that mean? So the first thing that comes to your mind is they own houses, they own rental units, or they own buildings where they rent them out for certain things. Okay, that is not how it is. So why many people are rich in real estate is because they have invested in real estate investment trust. I'll explain what that is. It's known as REITs. A real estate investment trust is a company that owns, operates, or finances income-generating real estate. Okay. So I'll give you an example. Who has ever seen the student hostels known as Kwetu, Kejani? Who has ever seen that?
I have seen.
You have seen it? You guys have seen it? Yeah,
Yes.
good.
Yes.
It's quite common. There are a lot. Wilson, Hurlingham, JKUAT, Quare. There are a lot. Around, I think, 15 properties all over Kenya, all over Nairobi. Okay? Now, another common myth that people usually tell you is that, building CG is for a certain politician. I don't know if you've heard that, but that's also very common. They'll tell you, oh, this one is for a certain politician, blah, 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 and all that. Okay. Now, let me explain why I was asking that. Now, a company that owns, operates, or finances income-generating real estate. So in the context of Kwetu and Kejani, these are student accommodation hostels. These are student hostels that they charge, okay? They charge students to live there. Now, you can invest in this Kwetu and Kejani. The question is how? There's a platform known as VUCA. So VUCA is in Swahili, in English it means crossover. That's what it means. VUCA rate, the real estate investment trust. Okay. So this Kwetu and Kejani is owned by Akon Holdings. If you just do a quick Google search, you'll see it's Akon Holdings. And these Akon Holdings have two types of rates. We have Akon iRate and Akon rate. So income. So there's the income investment trust and the real estate investment trust. Okay. Sorry, D-Rate, that's the name. D-Rate. Development Real Estate Investment Trust and the Income Generating Real Estate Investment Trust, I-Rate and D-Rate. So when you're investing in this Kwetu and Kejani, we're investing in the I-Rate, okay? What that means is we're investing in this student accommodation, okay? Now, what is happening here, Kwetu needs money to expand, okay? To launch in multiple areas. Kwetu, Kwea, Kwetu, all these places in Nairobi, they're also expanding to other places in Kenya, okay? Same to Kejani, they are in the same family of Akon, okay? Now, what happens is they have converted all the units that they own, okay? All those small hostels, each and every room, and put it in a trust, okay? They are converting the physical asset into a financial asset. And that is how you and I can invest in it. Okay, I want you to picture that. All the houses are being converted into income generating assets because they're income generating assets because students live there and pay rent. Then you now invest in that, okay? So you're not owning the units. It's not that you're buying the house. No, you're investing in the building itself, like the income generating asset of Kwetu and Kejani. Okay, I hope that makes sense. Okay, now the next question is, so how are we going to make money in this case? Two ways. Number one, capital appreciation. And number two, dividends. So picture this as it's a rental. It's like you're buying your own house, then you rent out to another person. Okay. Now here's where I want to come and mention why rentals are active income. Let me give you quite a few reasons why we these days, since time immemorial, rentals are regarded as active income. Rentals are active income. Okay, you remember the definition of active income? You put in your time, effort to get money. Okay, number one, this is a business. Rentals is a business, a full-time business. You're a landlord, which means you're in charge of finding tenants, managing repairs. Repairs are things like plumbing, electricity, repainting, handling complaints, okay? Advertising the property, okay? Oftentimes, most people use agents, okay? Clear? Now, let me give you a scenario. So, even if you hire a property manager and they take their cut, it is still your work to supervise all this. Now, take this scenario. The disadvantages of now rentals compared to rates. Number one, we have unpredictable income. This is very true for people who own rentals. you get a tenant, the tenant stays for 3-4 months, they leave. Yeah. Your place stays vacant for 2 months. So you employ an agent to look for a client. The agent takes 1 month to look for a client. The agent tells you, I've got a client, maybe a month or 2 months later. What happens next? The agent tells you they want 1 month of rent as their cut. You give them 1 month of the rent. So if you do that math, in 12 months, how many months have you had your rental occupied? So we had 2 months vacancy, 1 month rent you give to the agent. So in a month of 12 months, that is 3. 12 minus 3 is 9 months. You see, it is unpredictable. These ones may increase. You may have 3 months vacancy. The agent may charge you 2 months worth of rent. Okay. Then there is the issue of tenants. Tenants may fail to pay money on time. And remember, passive income should not involve your effort. So imagine you've agreed with your tenant, by 5th, pay me my money. They delay. And that money, maybe that is used to pay for your kids' school fees. Your kids must still go to school. If they don't pay school fees, he'll be back home. Or maybe, such things. You have, you know what you're doing with your money. So imagine if the tenant fails to pay rent on time. Okay. Then you spend months chasing payments, maybe legally, things like that. Okay. Then another thing, rentals are very expensive, especially to start. Some may take a mortgage in order to buy a house, then put it under rentals. So it is capital intensive. And let us not even talk about the taxes that are involved in owning these rentals, okay? From stamp duty to, I even have the list of the taxes here. Can you still see my screen? We have land rent, we have stamp duty. I don't want to go through them. Maybe you can just take note them down, then you go read on them. We have capital gains tax, value added tax. This is all in terms of land and rentals. Rental income tax, land rates, okay? Those are all the types of taxes that we have to pay, okay? And then maintenance, we have talked about maintenance. You see, plumbing issue, pest control, cockroaches, I don't know, repainting, appliances are breaking down, all those things. And then liquidity issues. You've had an emergency, you want to sell the house. You look for an agent, you look for a buyer, and then the buyer, since you're very desperate, you're going to take the house below market value, okay? Another thing is inheritance. You have one house, 6 children. You can't start giving the children, you take the master bedroom, you take the kitchen, you take this, you take this. It's practically impossible. You cannot divide that house, okay? Are you seeing? So these are the challenges. We have talked about the taxes, okay? Now, how will REITs, real estate investment trust, how are they advantageous in all of this? Number one, we talked about the business. First of all, this is a passive form of income. You are not worried if there are going to be students who are going to be staying in that place, all those things. You do not care. You just know that there's capital appreciation and dividends being paid out once or twice a year. Okay. The next thing, unpredictable income. Nope. In rates, income is very predictable. Okay. They say they pay their dividends in July or June. That's when they pay their dividends. Okay. We go to tenants. That is none of your business. You do not care if the hostels have people who are living there and all those things. Expensive. Rates are very cheap to start. You start with as little as 5,000 shillings and more. Okay. And then we go to maintenance, repairs, and all those costs. None of your business. Liquidity, very easy to make them liquid in terms of cash. You just sell the units you have, convert it into cash, take it into your bank account or M-Pesa. That's how it is. Inheritance. For rates, inheritance, you say that maybe you have 10,000 shares of VUCA. You say you have 3 children, divide by 3. Each child gets 3,333 shares. And now you're done. No need for that. Okay? So you're given a possibility of investing in real estate without owning the piece of property. Okay? So this is an investment portfolio of someone where you can see their current valuation is 515,695.50. So here you buy units. So when I started buying these units, they started at 20 shillings back in 2022, but now they're trading at 22.91 shillings. So you see, I've already gotten the capital appreciation through. So 2.91 shillings over those 3 years. It's actually even 2 years. Over 2 years. Okay, now depending on the number of shares I had, if I had 1,000, that's 2,000 extra. If I had 10,000 units, that's 20,000 extra. Okay, then dividends. They have paid out dividends. They usually pay out dividends twice a year. Okay, I think April and September, if I'm not wrong. Okay, so you see how predictable the income is. Now, for this, very simple. The normal documents you require, just log in, buy a unit. Now for this one, it is not similar to the NSE. Here, the units are always available. So you buy and sell as much as you want. It's not like the NSE where you have to wait for someone to buy your units. No. This one's the units are there in the platform. Okay, and that's how it works. Okay. So rates, we have seen capital to start is low. You don't have to deal with tenants or agents, no property repairs, reliable dividends, very easy to buy and sell. Okay. And then easy to pass on and make it liquid, to have liquidity. Any questions here?
I just have a general question.
Yes.
There are many products you've shown us. You know, we've learned about the stocks, we've learned about rates. I just want to see whether I get you. Is it like encouraged for us to have, quote unquote, a diversified form of investment so that you're not relying on one? Or what will make you, buy one against the other, and so on and so forth?
Yeah, so you remember we had talked about your financial goals. What are your financial goals? So the short term, medium term, and long term. So it's up to you to realize them and know what they are. Then from there is now when you want to see, okay, now what are the financial products that I want to invest in? Now, the most important thing I want you to know is we must diversify our portfolio. That is also something no investor just has one portfolio. You never see. It depends. For some, like for example, like Warren Buffett, who knows how he got rich? Who has any idea? So Warren Buffett got rich through the stock exchange market, okay? The New York Stock Exchange market. That's how he got rich, and that's how we got to know him, okay? Some people, they got rich through real estate. Some people got rich through like that, and that's how we know them. But these people, they have diversified their portfolio. Okay, that's the most important thing you should know. So you have a portfolio of money market funds, a portfolio of money market funds, you have rates, you have stock exchange, and you have a circle. You have diversified your portfolio. Okay, those are under the financial assets. Then maybe in physical assets, you have your car, you have your what, all those things. Okay, so depending on your financial goals, that is how you work on it. But the most important thing is, as an investor, you have to diversify your portfolio. So
Oh, thank you.
So then the last one, SACCOs. I'm sure you guys have interacted with this. It's quite a common. Yes. So one thing about SACCOs, for those who have not interacted with it, the main goal of SACCOs is acquiring of credit. You acquire loans through deposits. Okay. So in joining a SACCO, there are two things you should know. We have deposits and shares, or we call it the share capital. The deposits are, you deposit money on this SACCO. They can be withdrawn on whatever SACCO you join. Okay. But for share capital, you're buying shares in this SACCO. So this one there, you cannot withdraw. Okay. Non-withdrawable. That is something you should know. Okay. Okay. So they usually consider these two in terms of when they want to give you a loan, especially your deposits. Okay. So if you've deposited 100,000, SACCOs, an advantageous thing of SACCOs to banks is they give you a lower rates of borrowing, and then they give you high amount of money depending on your deposits. Normally, it's usually 3 to 5 times your deposit. So if you have 100,000, you're eligible to borrow up to 500,000. Okay. So for SACCOs, the most important thing is acquiring loans through deposit. Another good thing about SACCOs, they give dividends. Remember we talked about dividends? That's a plus for SACCOs. But the main thing about SACCOs, you cannot join a SACCO if you don't want to take a loan. Okay? And you see, you can take a loan for anything. You want to build, you want to, start a business or things like that. And I hope by now, from this knowledge that you have had, the 2 classes, we know that you cannot take a loan for useless reasons. For example, you want to buy a car. Okay, not a car, sorry. Yeah, a car can be something useful. For example, you want to buy a dress, or you want to, things that do not add value. Okay, do not take a loan for liabilities. That one, I think from now on, you guys know that, isn't it? Okay. Sawa. So for SACCOs, as I have said, through deposits and share capital, and they also offer dividends. Now you'd ask yourself, why should I join a SACCO, or why should I take a loan from the SACCO over a bank? There are some reasons why I encourage people to join SACCOs, especially those who want to take loans. Number one is the low interest rate. Okay, why SACCOs are better than banks? Okay, so SACCOs, the thing about SACCOs, they usually charge interest rates of things like 1% per annum with reducing balance. What that means is, if you take a loan of 100,000, okay, and it's at 1% per annum, sorry, per month, okay, you see the rate is 1,000 shillings. So you are going to pay 1,101,000. But if you pay this loan, let's say you pay 5,000 out of it, you remain with 96,000, isn't it? Yes, 96,000. So they're going to use this 96,000 to calculate your next interest payment in that month. But banks don't do that. Banks, they will charge you 22% per annum, and it's not with reducing interest. Okay, so SACCOs in the long run, they are affordable and manageable. Okay, and then we go to number 2. Another reason is they're not affected by CBK lending rates. You see, banks, they're affected by CBK lending rates. So if CBK said that the lending rate is to 20%, the banks will start off maybe at 22%, and that is what you're going to pay the loan. So even if you're repaying it at, let's say, 18%, if CBK changes the lending rate, you'll still pay at that rate. Okay. SACCOs, on the other hand, fixed rates. If it's 1% per annum with reducing balance, that is what it is. 1% per month, sorry. Okay. Number 3, for SACCOs, your savings will earn they were able to earn dividends even while securing the loan. Okay. So you have your deposits and shares, and you've taken out a loan. Your money will still earn you dividends. So for example, you've taken out a loan of $1 million due to your 300,000 shares and deposit. So as you repay that 1 million, remember your 300,000 is still earning interest on the deposit and dividends on the shares. Okay, that's how they're going to pay you off in terms of SACCOs. And then number 4, SACCOs, the loan eligibility is it's easier compared to banks. It is simple and accessible. Okay, as long as you're a member with good standing, you actively contribute, you can provide guarantors. Okay, it will be very easy compared to banks. Some banks will even tell you you must have a collateral. They are very strict with the eligibility criteria. Some will even tell you need an MOU between you and your employer. Okay, there is a minimum income threshold you should meet. Okay, that's another reason why you should join a SACCO. And then the last one is we have something known as member welfare benefits. So for example, if a member passes away while repaying the loan is usually insured, so the loan can be written off. Loans in banks are also insured, but depending on the loan you took, the loan might not be written off in banks. Okay, and then in some SACCOs, the beneficiary might receive double the money they had in their deposits and shares. Okay, this one can never happen in a bank. See, a bank is there for profit making. They can't start doing such things. So they may not even write off your loan, and then now your family might still be liable to repay that loan. Okay, so those are the member welfare benefits that are seen in SACCOs. Any questions on SACCOs? Then we have physical asset investments. So we talked about the financial asset investments. So physical assets are things like rentals, Airbnb, farming, Uber, and all those investments. They require time and effort compared to financial investments. Now, I think about farming, that's also another one. Quite common, especially with the older generation. They get money, they want to farm. Now, farming can be affected by external factors. For example, droughts. Droughts can wipe out all your animals, all your crops. Okay. And one thing about farming in general, you will see as an investor, now that you've started this journey, you'll come and see that farming is actually one of the least things people invest in. Okay. This is because farming, the return of investment in farming is almost zero if you think about it. Okay. For farming, you'll see it is one of the industries that the government must subsidize. Okay. So it's usually not financially sustainable, like in the long run. Yes, you might get a good harvest. This season, you got maybe 50 bags. The other season, maybe used certain type of fertilizer, you got 100 bags or that. But in the long run, it's not financially sustainable. Okay. And that's why the government has to step in and subsidize it. Okay. So if we were talking from a financial standpoint, nobody will farm. Nobody would farm. Okay. But now, if that happens, we're going to die of hunger, and we cannot rely on importing food for survival. So that's why the government will come in and subsidize. Okay, farming generally is used for it should be subsistence, where you grow your things, you eat with your family, like that. It is not a way of growing wealth. Generally, you cannot save and invest while doing farming. Okay. Because you see, first of all, it's an active source of income, where if you do not wake up, water the crops, add fertilizer, do weeding, all those things, your crops will die. So you have to clearly take care of your crop. Okay, it's not a way of saving or investing. Sorry, I know there's some farmers in the group. Sorry to burst the bubble, but that is the reality. But with that said, it's not that I'm saying you do not farm, it's just that you should know that farming is not a way of saving and investing. Okay, same to these other ones, rentals, Airbnbs, Uber, and all those. Those are purely businesses, and you should know that. Okay, now, for the last question now. So the last statement is, let's discuss your investment journey. And then the last one is, you have to now evaluate where should your money be. Remember the first question I asked you? Where should your money be?